Here's a strange thought. Somewhere right now, a guy in sweatpants is running an insurance company from his laptop. He didn't file paperwork, he didn't hire actuaries, and he definitely didn't tell his wife. But every Monday morning, premiums land in his account, and most weeks he keeps every dollar. Then one Tuesday, a single trade wipes out a year of profits in 20 minutes. So here's the question I want you to sit with for the next 10 minutes. If selling options is mathematically the same business as selling insurance, why does it pay like a casino, and who exactly is the house? To get there, we need to strip options down to their bones, forget Greeks, forget volatility surfaces, forget every YouTube thumbnail with a red arrow. A put option is one sentence. Someone pays you money today, and in return you promise to buy their stock at a fixed price if it crashes. That's it. You are selling crash protection. You are, quite literally, writing a tiny insurance policy on someone else's portfolio, and once you see it that way, the entire pricing puzzle becomes a question every insurance company has answered for 300 years. Picture a normal car insurance company. They charge you, say, $100-200 a year. Most years, nothing happens, and they pocket it all. But once in a while, you total your car and they cut a $30,000 check. The business only works because of one number, the expected loss. If the chance of a crash is 2% and the average payout is $30,000, the expected loss per customer is $600. They charge $1,200. The extra $600 is their edge. Multiply by 1,000,000 customers, and you get a skyscraper in Hartford, Connecticut. Now replace cars with stocks. You sell a put on Apple at a strike of $170, expiring next month, and collect $3 per share. What did you just become? An insurance company with exactly one customer, one policy, and one covered event. Apple closing below 170. The premium is your $3. The potential payout is whatever distance Apple falls below the strike. And just like the car insurer, your entire business depends on one question. What's the real probability of the crash, and what's the average size of the claim? Here's where it gets beautiful. The market actually tells you, out loud, what it thinks that probability is. The price of the put option is the market's best guess at the expected payout, plus a little extra, and that little extra is the seller's edge. Just like the $600 cushion the car insurer keeps. In options world, this cushion has a fancy name, the variance risk premium. But forget the jargon, it's the same thing your local State Farm agent earns. It's the price of being willing to absorb someone else's nightmare. But wait, if selling puts has a built-in edge, why doesn't everyone do it? Why isn't there a Vanguard ETF called Free Money from Scared People? Well, there sort of is, and we'll get to it. But first, ask yourself why anyone buys insurance in the first place. You know, deep down that your car insurance is a losing bet on average. You pay more than the expected payout. You do it anyway because losing $30,000 in one day is not just twice as bad as losing $15,000. It's catastrophically worse. It could end your life as you know it. Fund managers feel this same fear, but bigger. A pension fund manager whose portfolio drops 30% doesn't just lose money. He loses his job, his bonus, his reputation, and possibly the retirement of teachers in 3 states. So he buys puts. He overpays for them knowingly because the alternative is career death. Multiply this by every institution on Earth, and you get a permanent structural demand for downside protection. That demand pushes put prices above their fair statistical value. The gap is the option seller's salary. Researchers have measured this gap, and it's not subtle. On the S&P 500, the implied volatility priced into options has, on average, been about 4 percentage points higher than the volatility that actually showed up. 4 points doesn't sound like much, but it compounds into one of the most reliable return streams in finance. Strategies that systematically sell S&P puts have produced equity-like returns for decades. The edge is real. The math checks out. The insurance company works. So we've solved it, right? Sell puts, collect premium, retire to Portugal. Except, and this is where the casino comparison gets uncomfortable, the shape of the returns is completely deranged. Imagine a slot machine that pays you $1 every pull, 99 pulls in a row. On the 100th pull, it reaches out and takes $200 back. Over time, you're up. But your equity curve looks like a staircase climbing toward heaven with a trapdoor every few months. This is called negative skew. The everyday outcome is a small win. The rare outcome is a catastrophic loss. And here's the cruel part. The human brain is exquisitely engineered to misread this pattern. After 10 weeks of small wins, your gut whispers, "This works, double the size." That whisper has bankrupted more option sellers than any single market crash. February 2018, March 2020, the Volmageddon, entire funds vaporized in hours because they'd been collecting nickels for years and forgot the steamroller was still moving. Now compare this to a real insurance company. Allstate doesn't go bankrupt every time there's a hurricane because they hold reserves, they reinsure, they diversify across millions of uncorrelated policies. The lone option seller does none of this. He's selling 100 puts on the S&P 500, which means he's selling 100 policies that all pay out on the exact same day, the day the market crashes. That's not insurance. That's writing fire insurance on 100 houses in the same building. This is the hidden math nobody puts on the thumbnail. Your average return can be positive, your win rate can be 95%, and you can still be ruined, because ruin isn't about averages. Ruin is about the one path through the tree where you don't survive long enough to collect the average. A coin that pays you $1 on heads and takes everything on tails has a positive expected value if heads is likely enough. But flip it 100 times, and almost surely you lose everything along the way. So how do the survivors actually do it? They borrow the playbook of real insurers. First, position sizing. Never sell so many puts that one bad day can kill you. If a 20% overnight crash would wipe you out, you've sized wrong, period. Second, they buy reinsurance, cheaper, further out-of-the-money puts that cap the catastrophic tail. They give up some edge to stay in business through the next Volmageddon. It's the difference between a casino and a guy holding a bucket under a leaking dam. Third, they diversify across underlyings whose crashes aren't perfectly correlated, though in a real panic, correlations go to 1, so this helps less than people think. And fourth, the deepest lesson, they accept that the edge is real but small, and that leverage is the thing that converts a small edge into a small fortune or a smoking crater. The casino's edge on a blackjack table is around 1%. They get rich because they play a billion hands and never bet the building. Your edge selling puts is optimistically a few percent a year. Treat it the same way. So back to the question we started with. Why does selling options pay like a casino? Because structurally, it is one. The math of the put seller, the car insurer, and the blackjack house are the same math. Collect small, certain gains in exchange for accepting rare, large losses, and rely on volume and prudence to let the average win. The edge is genuine. The pension manager's fear is genuine. The premium is paid for a real service. But the trap door is also genuine, and it does not care about your win rate. So the next time you see a tweet about selling puts for steady income, you'll know exactly what you're looking at. Not a hack, not a glitch in the market, just a very old business dressed in new clothes, one where the premiums are real, the math is honest, and the only question that matters is whether you've sized your bet small enough to still be standing when the tail finally arrives. Because in this business, the house always wins. You just have to make sure you are, in fact, the house and not the building.